Imagine this. You get paid on Friday. You feel responsible. You feel productive. You move some money into savings, you pay your rent or mortgage, you cover groceries, maybe you even invest a little. And by Wednesday, you're checking your bank account like it personally betrayed you. You make decent money, not struggling, not rich, just stuck. Every year your salary goes up a little. Every year your expenses somehow go up more. You're not reckless, you're not irresponsible, you're doing what you were told to do. And yet, your net worth feels like it's moving in slow motion. If that sounds familiar, here's the uncomfortable truth. It's not your income, it's your ceiling. Today we're talking about the 5 wealth ceilings that keep middle-class earners stuck. And once you see them, you can't unsee them. My name's Leonard, and I spend way too much time thinking about the 5 wealth ceilings that keep middle-class earners stuck. If you're someone who earns a solid income but feels like your net worth isn't growing fast enough, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because look, this isn't about hustle culture, it's about structure. Let's start with ceiling number 1. Wealth ceiling number 1, the lifestyle expansion trap. Here's the thing, the moment your income increases, your life expands to meet it. You go from making $60,000 to $80,000. That extra $20,000 feels huge, but instead of increasing your investments, you upgrade your apartment, your car, your vacations. Suddenly, you're still saving, but at the same percentage. Now here's the math. According to data from the U.S. Bureau of Labor Statistics, when income rises, spending rises almost proportionally, especially in middle-income households. It's called lifestyle inflation, and it's brutally efficient at keeping people in place. Let's say you earn $70,000 and save 10%. That's $7,000 per year. After 10 years, assuming a 7% average return, that becomes roughly $97,000. Now imagine instead you increased your savings rate to 25% once your income rose. That's $17,500 per year. Over 10 years at 7%, that's around $241,000. Same income, different ceiling. Here's what most people don't realize. Your savings rate matters more than your salary. Middle-class earners don't get stuck because they don't earn enough. They get stuck because every raise gets absorbed. Psychologically, this happens because your brain recalibrates normal within weeks. That nicer apartment becomes baseline. The new car becomes expected, and going backward feels like failure. But wealth isn't built on what feels normal. It's built on what compounds. Action step. Every time your income increases, automatically allocate at least 50% of the raise towards investments, not savings. Investments. You never miss what never hits your lifestyle. Wealth ceiling number 2, the income ceiling illusion. Now this is where people get defensive. You might be thinking, Leonard, I just need to earn more. Yes, higher income helps, but here's the illusion confirmed by IRS income data and Federal Reserve wealth surveys. There is a massive difference between high income and high net worth. The Federal Reserve Survey of Consumer Finances consistently shows households earning over $150,000 often still have modest net worth relative to their income. Many are asset-light and debt-heavy. You can earn $200,000 and still be fragile. Why? Because income is active, wealth is passive. Let's break this down. If you earn $120,000 per year but spend $110,000, your life depends entirely on your job. If you have $1 million invested at a 4% withdrawal rate, that produces $40,000 per year without you working. Which one is freedom? Middle-class earners often hit a psychological ceiling where they focus exclusively on income growth, promotions, certifications, side hustles, but neglect asset accumulation. They build a taller ladder, not a stronger foundation. This is where it gets really interesting. Once your investments start generating even 10 to 20% of your annual expenses, your behavior changes. You take smarter risks. You negotiate better. You stop tolerating toxic jobs. Action step. Track your passive income ratio. Divide your annual investment income by your annual expenses.
Your first target is 10%. That's when the psychological shift begins. Wealth ceiling number 3, the comfort debt ceiling. Now we need to talk about debt, not the obvious kind, the subtle kind. Middle-class earners are masters of affordable payments. Car loan, $600 a month. New phone, $50 a month. Furniture financing, $120 a month. It doesn't feel dangerous, but here's the math. If you carry $25,000 in consumer debt at an average 18% interest rate, which is common for credit cards, you're paying $4,500 per year in interest alone. That's money working aggressively against you. Now compare that to investing $4,500 per year at 7% for 20 years. That's over $185,000. Same dollars, opposite direction. Here's what most people don't realize. Interest compounds whether it's for you or against you. Psychologically, debt lowers your risk tolerance. It traps you. It forces you to stay stable instead of strategic. And the middle class loves stability. Action step. Before investing aggressively, eliminate high-interest consumer debt. Anything above 8% is mathematically competing with your investments. You don't build wealth while bleeding interest. Wealth ceiling number 4, the information ceiling. Look, this one might sting. Most middle-class earners are financially literate, but not financially strategic. They know what a 401k is. They know what a Roth IRA is. But they don't understand asset allocation, tax efficiency, and compounding timelines deeply enough to optimize. According to Vanguard's long-term research, proper asset allocation accounts for the majority of long-term portfolio performance variability. Not stock picking, not timing, allocation. Yet many people sit entirely in cash because they're afraid of volatility, or they chase hot stocks because they want faster results. Here's a simple example. Investor A keeps $50,000 in a savings account earning 1%. After 10 years, about $55,000. Investor B invests $50,000 in a broad index fund averaging 7%. After 10 years, about $98,000. Same dollars, different understanding. Now you might be thinking, but what about market crashes? Good question. Historically, the S&P 500 has returned roughly 10% annually before inflation over long periods, despite recessions, wars, and crashes. Volatility is the price of admission. Action step. Adopt a simple, low-cost, diversified index strategy. Automate contributions. Stop trying to outsmart the market. The goal isn't excitement, it's exponential growth. Wealth ceiling number 5, the identity ceiling. This is the one no one talks about. Middle-class earners often have a fixed wealth identity. They see themselves as responsible earners, not investors, as workers, not owners, as savers, not capital allocators. An identity dictates behavior. If you subconsciously believe people like me don't become wealthy, you'll sabotage your own progress through small decisions. You'll sell investments too early. You'll avoid calculated risks. You'll delay starting that business idea. This is where it gets really interesting. Studies in behavioral finance show that people anchor to their peer group's income and spending patterns. If everyone around you spends $80,000 per year, that becomes your mental benchmark. Your ceiling becomes social. Wealth, however, requires breaking social symmetry. You cannot live like everyone else and expect different financial results. Action step. Redefine your identity as an investor first, employee second. Every dollar you earn should have a job. Every dollar you spend should be questioned, not obsessively, strategically. Bringing it all together. Let's recap the 5 ceilings: lifestyle expansion, income illusion, comfort debt, information gaps, identity limits. Notice something? None of them are about intelligence. They're about behavior. Middle-class earners are often smart, disciplined, hard-working, but they're operating inside invisible constraints. Break one ceiling and your wealth accelerates. Break all 5, everything changes. Here's a simple 30-day reset plan. Increase your savings rate by 5% immediately. Eliminate one unnecessary monthly payment. Automate investments into a low-cost index fund. Track your net worth weekly. Write down your 10-year wealth target and reverse engineer it. Because here's the final truth. Wealth isn't built in dramatic moments. It's built in quiet, repetitive decisions. The middle class isn't stuck because it's incapable. It's stuck because it follows patterns that feel safe. But safe rarely compounds. Disciplined does. And if this resonated with you, if you saw yourself in at least one of these ceilings, that's a good sign. Awareness is step 1. Action is step 2. And consistency? That's where exponential growth happens. If you want more breakdowns like this, practical, math-backed, psychologically honest, subscribe. Because we're not here to chase money, we're here to understand it. And once you understand it, you stop being stuck. You start building.